First up, how can we not talk about the decline in markets today? I guess it's one of those days where you can use the word bloodbath. The Nifty has seen its most significant single-day decline in over 9 months. It's dropped more than 400 points from its peak. The downturn led by stocks like Adani Ports and Adani Enterprises. And then within the broader markets, both the small cap and the mid-cap indices have seen substantial declines. The PSU Bank index has had its most substantial single-session drop in over a year, with Indian Overseas Bank and UCO Bank at the forefront of the losses among the banks today. And despite hitting that record high, the energy pack in the Nifty has closed in the red. Also, both Pharma and IT indices have ended up with losses at the end of today's sessions. So we've seen the kind of declines in the markets today. But what are the reasons for this, and what can we expect going ahead from here? Let's find out. Mayuresh Joshi is back with us, the head of equity at William O'Neill India. Mayuresh, it's always good to get your perspective on a day like this, and perhaps investors need some reassurance, because despite these global peers that have been rising, in our markets, we've taken a fall in the second half of today's session. What do you make of this sudden drop in Indian equities? Are you in the camp that believes that this has a lot to do with the long overdue correction in the broader markets? After all, this was the worst session in 3 months for the small caps and the worst in 12 months for the mid caps.
Evening, Vikram. That seems to be the case, and the probability probably hinges more in terms of profit booking that was probably done in the markets today. Having said that, the kind of structural positives that the Indian market probably exhibit, those structural positives still continue. So today's fall is not a structural downside for the markets. It's a leg where the markets are facing, and a phase of the markets where profit booking is probably required. And I think that profit booking came through today. Yes, I think it was quite brutal as far as the broader markets are concerned. But when profit booking probably happens, after a roaring bull run that we've probably seen within the mid and the small cap space that we have all witnessed in the past 3 to 6 months, I think this should be taken with a pinch of salt. So yeah, I think the presumption is that it was money being taken off the table. And we've also seen historically, Vikram, in bull markets, you do get phases like this where there are these sharp intermittent corrections which probably come through, but the recovery is also equally good. So yes, I think corrections is the way I would put it. Profit booking, not a structural downside that we have started witnessing for the Indian.
Right. So profit booking is probably the reason, according to Mayuresh. But you look at the Bank Nifty, where we've seen intense selling pressure today. If one believes that structural story and that it is intact, like the RBI too will have us believe through the bulletin they put out, then tell us, Mayuresh, in your opinion, which sectors seem at least vulnerable at this time, even a little susceptible right now, especially from the valuations perspective, sectors where you see some amount of froth and the kind you'd suggest investors should be wary of?
So Vikram, largely put, I think a lot of sectors are close to fair valuations very earnestly. And therefore, the euphoria that you're probably seeing in the markets is a build-up of both liquidity that is coming through, and obviously the positive signs both on a macro and a micro scale that India as a market is exhibiting. Having said that, in lieu of how earnings are expected to play out, I will be very, very watchful for the FMCG space for 2 reasons. One, I think in terms of the deficient rainfall that we have witnessed because of the El Nino factors and the inflationary conditions thereof, semi-urban and rural India are still reeling through the stress in terms of both inflationary impact in terms of their discretionary spending. And therefore, volume recovery that one was really expecting to come out in real earnest in this quarter might get delayed by a couple of quarters, and we'll probably have to wait out on how the next monsoon probably plays out, which is a couple quarters down the line. The second element and angle is also in terms of what policies and incentives the government probably takes, both in terms of MSP price increases, as well as the expectations in terms of what happens through the PDS distribution schemes, as far as the rice and wheat grains are concerned. So to that extent, the runaway that we've probably seen in a lot of FMCG stocks, so you can't paint the whole sector with the same brush. Sure. I think I'll be a little bit more cautious in terms of seeing how numbers play out. And with the latest circular that has probably come through, In fact, two circulars, one in terms of personal loans and the provisioning thereof, which obviously takes sheen off in terms of the CET1 ratios, as well as the latest circulars in terms of investing to AIFs. I think that is going to take a hit in terms of the second run NBFCs as well, which might have exposure towards this parts of the market. And therefore, the second run stocks within the NBFC space and certain stocks within the FMCG universe, I will probably wait it out in corrections like this.
Then there are concerns over oil supplies, Mayuresh. Oil supplies through the Red Sea route. That seems to have dented some amount of investor sentiment today.
Yeah.
But oil in general is an ongoing concern, especially for India, isn't it? I mean, notwithstanding the recent decline we've seen in crude oil prices, now that prices are ticking up, there is this unpredictability about oil prices. How do you hedge risks that emerge from oil price volatility?
So I'm not a commodity expert, Vikram, but what I've been reading through reports and the expectations that broadly a lot of management stroke analysts have put forth is that crude might just stay in a range between 80 to 90 odd dollars. We are probably getting there at that lower end of the range as we speak. And therefore, with events like this, obviously props up prices to a significant impact. Impacting, obviously, I think the users of crude and crude derivatives as well. Having said that, the expectations broadly that I am reading through is that there should be some element of resolution that might come through. And if that happens, again, you will see a short correction or a sharp correction that probably might be witnessed in crude prices. But I think the pass-through effect is obviously there. But to a large extent, I think if you're presuming and if the assumption is between 80 and 90, I think a large part of the market is getting covered in terms of that range. Obviously, I think crude derivatives are going to react accordingly. If crude prices spike quite significantly above this range, the pass-through will become a little bit difficult, and that might have an impact in terms of demand and volumes. But similarly, I think if they remain in the same range, I think the kind of demand dynamics that can come through can be reasonably expected to be stable over the next few quarters. So I'm not overly perturbed with the presumptions that we probably have on the table right now. And therefore, as I said, for auto ancillaries, I think even a few of these tire stocks can continue doing well.
Also, last week's Federal Open Market Committee, the FOMC meeting, has seen 3 rate cuts marked for 2024, and that sparked a rally in the financial markets. Mayuresh, how is that theme likely to play out in Indian equities now as we gauge how foreign capital flows will affect the ebb and flow of our markets?
So to a large extent, the Fed pivoting and expectations of rate cuts starting as early as the second quarter of the next calendar year is what the markets have largely started penciling in. As the Fed action starts taking center stage at some point in the next calendar year, a lot of central bankers, including bankers, will probably also initiate rate cuts in the domestic context. And therefore, that spurs a lot of economic activity, both manufacturing, and gives a huge support in terms of the GDP growth as well. Having said that, with the expectations of inflation expected to remain under control and expected to come to the levels that a lot of central bankers are probably looking at, it should have a positive amplifying effect or a multiplier effect. With rate cuts, a lot of the banking stocks should react very, very positively, NBFCs as well. And a large part of the lending universe, as interest rates start going down, the benefits in terms of leverage coming down on their balance sheet helps cash flows to a large extent. And therefore, the whole concept in terms of infra manufacturing as a theme should start doing well. And at the same time, with rate cuts expected to come through, a lot of foreign flows obviously get diverted to emerging economies. So you expect a fair bit of flows coming to India, because India is expected to remain the best emerging play, at least for the foreseeable future.
You sound extremely sanguine, and that's going to be music to the ears of investors who would get a little rattled by the kind of sudden and sharp drop that we've seen in the equity markets. But like you pointed out, in a bull run like this, perhaps it is to be expected. We'll continue to watch the markets and continue to get your perspective as well, Mayuresh. Thanks indeed for joining us on this edition. Great to have you with us. Also, we got a word